Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, give us a like, share, subscribe. My guest today is Evan Thorpe, Principal for Asia Pacific at SixThirty Ventures. We spoke about the changes to the venture capital industry over the past few years with the change of interest rates, what that has meant for investing into startups, his view about what kind of fintech companies are valuable, and how he's thinking about some of the big questions of how to help financial institutions make better use of fintechs for their own productivity. And lastly, of course, we talked about AI, China, and what that means for global venture capital. Evan Thorpe from SixThirty Ventures, welcome to DigFin VOX.
Thanks so much for having me, Jame. I'm a big fan of the pod and a big fan of DigFin, so thanks so much.
Appreciate that. Thank you, Evan. So you are the Asia Pac principal at SixThirty. So you're a venture capitalist, and your firm really specializes in fintech. So I'm very interested to speak with you about what we're looking at. It's been the past 2 years have seen a huge shift for the entire venture industry, and of course, all the portfolio companies downstream are massively impacted by that. And now we're into almost 2025. We've got new challenges around the world, and I would love to use this time to talk about kind of the state of fintech from a VC's perspective, what's hot, what's not, and where you think the action is going to be next year. So thank you for your time today. And why don't we just get straight into it? What is hot and what is not? Or maybe you can even back that up a little bit and just say, kind of from your perspective as an investor, as a GP, what have been some of the big changes impacting the way that VCs look at fintech?
Yeah, I think you framed it very well, that impact is a key word here. There's been a big shift, as you alluded to, over the past couple of years in the markets. In some ways, financial services has been impacted a great deal because it's so much the part of everyone's lives at a retail level, at an institutional level, at a global level. You have financial institutions certainly moving through a certain amount of change themselves, technology that can apply a certain amount of leverage in solving the big problems facing those large institutions, financial institutions, insurance institutions, healthcare institutions, where technology can be applied for that leverage so that they can serve their own end customers better and their own clients better. There's a certain amount of exposure that they've experienced during that shift, and that impact has been felt. That extends to fintech in the sense that because fintech companies are also very much today, more than ever, a part of everyone's lives, again, institutional level and retail level, there has been probably more higher to fall for fintech companies than maybe some other categories. That having been said, fintech companies, while impacted, also have the opportunity now to ride a resurgence in a few different verticals, in solving a few different key problems, and being a part of a revival in venture globally as well as in the region.
Yeah. So how much of that, just to be a little more specific then, how much of these issues for fintech companies have been because of issues with the VCs themselves, i.e., we saw the interest rates go way up in the US starting in 2021, and really the end of a long era of free or almost free capital. And from a GP's perspective, your end investors, the LPs, the institutions, the big money sources, they probably decided that venture on a risk return basis wasn't looking as attractive as it used to. So that led to a huge change in the way that money was being allocated to startups of all types, right? So it became much more about, I need to see some deliverables, I need to see some profitability, I need to see that this thing's going to IPO, as opposed to let's just keep subsidizing eyeballs or whatever it is the strategy. So what the impact on fintechs is it really coming from this in terms of the dynamics within VCs, or do you see it as also rising interest rates just made it more expensive for small companies to borrow or to get access to capital in a broad set, and that has had a knock-on impact on them? Your thoughts.
Yeah. And thanks for setting it up that way. I'd say broadly speaking, more the former than the latter, more about the markets and the positioning that certain companies have within those markets against that context, rather than subscribing to the idea that startups and fintech startups specifically were somehow part of this cycle where they're an artifact of an interest rate environment and a certain moment in time rather than a significant part of an economy and a significant part of any number of financial services verticals. To give you an idea of where I'm coming from and where 630 is standing in this, our LP base is primarily US headquartered financial institutions and strategics who are not only thinking about the return side of the ledger, but also the strategic side of the value that collaboration with startups through alignment with a GP like ourselves can bring about. And so because our LPs are very much thinking about not so much where are startups going to be able to be helpful, but they're starting from where are the problems that need to be solved and what role, rather than is there a role
Mhm.
for startups should they be playing. And when we have conversations with our LPs and we sit down with them, it's a conversation about how is that role evolving? Where are the teams that are going to be able to bring better leverage to solving those problems so that they can work together? We very much subscribe to the idea that it takes a village to solve these problems. It takes a village to raise a startup. It takes a village to bring the trust together from both sides of a corporate and startup relationship.
What is the way that you work with the LPs in terms of, it sounds almost like you're like an outsourced version of a corporate strategy approach as opposed to pure financial return driven investor. Um, so I'm sure you can clarify that for me, but also just give me a sense of if you're sort of playing for this, how to incorporate them into problem solving for financial institutions. Where do you play in the startup space? Like, what is the kind of the ticket
Yeah.
size, the seed level? Like, where are you?
Yeah, yeah. So happy to run through that. And certainly there's many different formats of collaboration that exist nowadays between startups and financial institutions. So in many ways, we want to make sure that we're playing to our strengths in being able to provide value through the way that we believe we can best do that. It doesn't mean that there's only one model or another. Outsourcing wouldn't be the word that I would
Okay.
use because the stakes are much too great to kind of hand something off completely to somebody else. There's a great deal of change that needs to happen within a financial institution in order for them to evolve and to move forward as regulated institutions. There's not necessarily going to be the world being turned upside down and all the banks that we know disappearing and a set of new banks appearing. Same goes for asset managers, insurance companies, et cetera. There's a regulatory moat that exists around them. However, even if that protects against extinction level survival type events, there's probably more that happens on an incremental basis that is not enough to catalyze change at the level of a large financial institution. When I say catalyze change, what I really mean is that even though there's more technology today, technology has become cheaper, it has flattened the playing field in certain industries, it's changed pricing dynamics, distribution, unit economics, et cetera. Even though it's changed and influenced those levers, in many cases, the way that we think about it is that technology has gotten easier, but change has gotten harder. And so for those financial institutions to change, it's not just a matter of adopting technology. They've already done that. It's not a matter of simply setting up a function for venture collaboration, whether it's in corporate development, whether it's corporate venture capital, whether it's a broad manager program that they're running. Irrespective of the investment format and irrespective of the technology in question, it's just not the easiest apparatus to move or re-engineer. And what we believe is the locus for change to take place, and that catalyst is the bridging of trust between those two sides, building that trust, delivering what one promises, and moving forward through a collaboration that is a multi-year affair. And the way that we believe that works is to bring capital around that to construct that alignment. Our funds are also multi-year, consistent with the venture format. The returns and the payoff with a collaboration, particularly with a large enterprise, and the investment returns and exits for the venture format are also consistent. And so you can see that there's a few key elements that align timeline-wise and functionally that would bring a certain amount of tailwind to that collaboration. But that doesn't really get you all the way out of the woods. You have to actually be able to bring about meaningful change and have that happen. So to answer your question about how we go about doing that with us as a GP, we bring structure, we bring a portfolio approach, and we bring a thesis around how we operate and that model of collaboration and building trust, as well as bringing our own background as individuals, bringing the venture format itself, and those LPs behind us that are able to act as a force multiplier when they all bring their capabilities to bear and their network to the startups in our portfolio.
So
I didn't
Evan,
answer your question.
yeah,
It strikes me I didn't answer your question about our
yeah,
own investment
sure.
approach. So we're very thesis driven. We believe that if there's going to be startups in a portfolio that are going to enact meaningful change, it needs to be able to overcome the headwind of just how difficult it can be to enact change within an organization. And so as such, the payoff has to be great. It has to be solving a big problem. One thing that I'm hearing less to your question about what's hot and what's not,
Mm,
folks have had enough with what's referred to as fintech incrementalism.
mm,
Just building a better mousetrap or one step better than what existed before, that's not enough. It has to be a sufficiently large problem so that the reward for solving it overcomes the deployment of resources, capital, talent, attention, bandwidth towards solving it, which can be considerable within an organization. And then that means that as we construct that portfolio, we want to invest at that juncture in a startup's journey when they are ready for prime time, so to speak, within the context of being able to collaborate meaningfully with a large financial institution. But in a world where startups are often known to move fast and breaking things is off the table for systemically important institutions, and you can't have that. So how do you still move fast if you're not allowed to break things? Finding the way to do that requires being new enough that those large institutions can still shape the journey, but still mature enough so that that idea can be meaningfully applied. And so that means seed, Series A, occasionally a half step earlier, occasionally a half step later, finding the right company at the right time that's solving the right problem and needs the village around it to accomplish it.
I want to dig into that, but I want to take one step backwards and talk about, I guess, talk about timescales and incentives. A large institution can wear a startup out with endless proofs of concept, may not even be paying for them sometimes, or just treating them like a vendor. If it doesn't get instant results, then they get fired like a vendor. Um, and although an institution, in theory, can be extremely patient the people working in it, they tend to be working off 3 year, let's say, bonus structures and KPIs. And then also your time frame. I mean, a typical VC is 10 and maybe two. You've got a period of time where you've got to invest in a portfolio of companies, and you've got a period of time where you've got to do something. Either you're going to double down or you're going to do a sale or something. So, and then of course the startups are often just trying to get by. So depending on where they are and who they are. Um, so just tell me a little bit about how do you try to manage these issues of differing incentives and different timescales?
Yeah, yeah. You got to get into it for the right reasons. And that applies to both sides of the equation. That applies to the startup, the CVC, the corporate, any number of different players that are in the equation. They have to be getting into this relationship for the right reasons. And so where that really enters in is there's that idea that exists in folks' mind of, oh my gosh, what if Hilton had been on the cap table very early at Airbnb?
Mm.
Well, if there's a meaningful reason for the company's development that relationship is going to bear, then fantastic. If you're doing it just because there's a certain amount of FOMO or there's paranoia or concern, insecurity in your place in the future of the economy, that's another question. Same goes for the startup side. Are they getting into these relationships because it's a quick way to get some to get some contracts, to get a deal across the line? I don't know that any mature founder out there subscribes to the idea that there's such thing as a quick contract, or a quick commercial discussion that exists in the world of enterprise fintech. So
No.
as a result, they have to be going into it believing that it's going to be productive and knowing why they believe it's going to be productive, and those ideas being the same on both sides. We've seen it so many times before, and you've alluded to it very accurately, I think, that on one side, the startup believes that they're going to get this huge lift from working with a large strategic that's one of their investors, and ultimately they feel like the process moved too slow and they ran out of oxygen in the meantime, and the company died on the vine, so to speak. On the other hand, you often have situations where folks on the corporate side look at an opportunity. It sounds like it's great. A lot of promises are made, and then ultimately the founders are accused of having not delivered on those promises. So both sides feel as though they've been wronged in this, despite the best of intentions, and it all ends in tears. If those two parties, not that this is a cure-all, but if those two parties can get on the same page earlier, they can understand why they're getting into it, then that's where we see where there's real potential. And one barometer for us engaging that is who's really there to iteratively learn and understand from the process. Are they there to understand not just this corporate and what their particular needs are, but what goes into the discipline of selling to large institutions based on trust? What you
Yeah.
learn from one sales cycle should be extensible into the others. And if it's not, then that's where it's maybe a little bit more transactional, and people aren't there to learn. We want to
Yeah.
be there for the corporates that are there to learn. We want to be there for the founders who are up for that journey.
And your capital, the capital that you're putting into these startups, is really there to give the startups enough breathing room to sort of get through this process if you feel like they're on a good journey with a significant institution, then and they just need runway. Is that really what your funding is there to provide?
Companies certainly do need runway, and ultimately, at some level, all companies die of the same affliction, which is that they run out of money and then that's it. How it happened may vary, but what happens is generally the same. And while we do provide capital, that capital there is generally to just incentivize and align all of the parties rather than to provide a certain amount of CPR, or breath forced into the lungs of these companies. Because it takes a village, there's a need to bring together not just us around the table, but others as well. I've used the word collaboration again and again, and it's no coincidence. There's a need to align across a number of different investors who can all come together. We have frequent collaborators that we have both on the strategic side as well as the typical financially driven VCs that we bring together all around the table in order to have those happen. So we're typically not the only VC that is in on a particular round, and we're typically not leading with the capital, although it's certainly a necessary part of the apparatus and how it works.
So let's talk about let's get into some of the fun stuff, Evan. Let's talk
It's
about
all fun stuff. It's all
it's
fun
all fun
stuff.
stuff. All right, but we've been talking sort of at a very kind of technical, strategic level here. And now I'd like to sort of bring it down to some of the actual fintech themes, particularly those in
Yeah,
Asia Pac, since that's where
yeah.
we play. So give me a sense of maybe during the bubble years, is particularly some 218 to 221. At that point, what was really clicking for you? What were the kind of investments that you're making? Were you able to make any good exits as well? And then we can maybe get a sense of what that looks like today, so we get that contrast.
Yes, that's a great question, and we can definitely dig into some specifics there. So you turn back the clock 3 years, and you had the rise of embedded finance in Asia. You certainly had unlock of data properties that were going to supercharge financial inclusion, growth, embedded finance. It was a match made in heaven between e-commerce and fintech.
Mhm.
And in many ways, you saw the growth of e-commerce platforms, you saw the growth of brands, you saw the growth of digital assets and the infrastructure around that. You saw a lot of fintech doing what fintech does well: money, resources allocated to as many people at the right time, the right product in the right way. That was very much a huge part of the narrative here in Asia. Now, fast forward to today, a lot of those, it's still the same ingredients. Asia is still very much looked to be the growth driver of large pockets of the global economy. Financial inclusion is still very much needed given the funding gap that exists for individuals and for businesses in the region. And fintech very much still looks like the right tool for the right job. And then when we break down fintech, whether it's stablecoin infrastructure for payments, whether it's embedded finance solutions that are embedded in e-commerce so that digital storefronts and digital merchants can sell their products and operate more effectively on a working capital basis, can access credit that is actually befitting of their profile rather than relying on outmoded forms of thin file or no file
Yeah.
properties out there for adjudicating credit. It's a lot of the same ingredients. It's just being recombined in a way that hopefully is more thoughtful and brings a better outcome. So how does one transmit whether or not something is thoughtful and deliberate in a fast-moving world of venture transactions and pull out outcomes the other side in the form of exits that are going to be befitting of the venture format? That's where things are starting to change, because there's a divergence of opinion around the role that venture capital is going to play in fintech. And that does map to the different categories as well. And what I mean by this is that you're going to have those folks who are going to play the ground that's on the field here in Asia in a very concrete way. This means investing in businesses that are perhaps more roll-up style investments in brick and mortar businesses. This is leaning into consumerism and consumption trends. This is leaning into real estate and other fixed asset value properties. Those types of investments, one could argue, are not really venture capital, and judged by the fact that their returns are not going to be those 10x's, 100x's, but maybe something that's seen as a lower risk, solid 3 to 5x. So I'm speaking in very broad terms here, but the idea of having the roll up of dentists and clinics,
Mhm.
the opportunity to get into certain businesses that are very relevant and very investable, but don't necessarily look like venture capital is one direction of travel around this. The other direction of travel is that it's still startups, it's still companies that are reliant largely on a small amount of early capital going very far because their fixed costs and their variable costs are actually quite low. And now we're into this sounds and looks and feels like venture capital. And if it's whether it's monetized through fintech or whether it is a fintech company, right? There's going to be there's going to be the resurgence of venture investable ideas, and that maps to those step function change type opportunities, things around digital assets, embedded finance, the intersection of health and wealth. That's a big theme for us globally. People are living longer, they're working longer, they're not necessarily living better, they're not necessarily living healthier. That's a problem all around the world, whether you're in the United States or in Asia. And so those opportunities where things can change and be big, that's where venture capital is still very much going to be the right tool for the right job against those fintech companies that are going to be solving those problems very ably. By the way, we've made it this long through the conversation without even mentioning AI. AI perhaps is the curveball that's being thrown into this schism of what's investable and what's not within Asia, because it's debatable whether or not AI is going to have the same look and feel and operational consequences in a startup format that traditional SaaS did. I think there's a lot of people out there that would argue, no, it's not debatable. It's definitely different. If that's the case, then in what ways is it different? In what ways is startup investing and the role of AI in a venture portfolio different than SaaS was before? And so to your point around what has changed, maybe that's a change of significant magnitude that would overshadow other changes.
On a geographic basis, 3 years ago or so, the China market was still open to US and global venture capital. It was much of the Chinese VC story was really almost a dollar story and offshoring a lot of the governance and the rewards. That's over. So as you're looking at opportunities in this region, is China still investable for you?
That's a great question. So I think you've hit the nail on the head that you don't have to go back too far in time to find a time when foreign capital was very much looking at China very directly. And given your work on Planet VC, you literally wrote the book on the subject of where foreign VC and the traditional Silicon Valley and European models mapped well to what was happening in Asia and where it didn't. And certainly China having very specific local attributes about those startups, making it a very specific opportunity, both captivated VCs looking at China, including those from the United States at a point in time, and also those attributes maybe giving them pause later on when the context changed. I think that China writ large is still very much an investable market. I think that if in many ways, if what you're running is a major venture program that is global in scope, largely you can't ignore large markets in Asia, specifically India and China. Getting the timing right about capital in and out of those investments, that's another story.
Right.
And probably one that even the most patient capital would probably have to be very careful about getting the timing right on that. Everything that's happening geographically right now is probably introducing more volatility and uncertainty to that than ever before. But I think that if you take a long enough view, the tailwinds that exist for large markets in Asia, like India, China, and Indonesia, then investability is more a function of capability and capital applied against time. We could go into a few different side plots that exist there, But that's the
Well,
way that I look at it.
yeah, I mean, the reason I was asking that really is because when it comes to AI, particularly if we're talking about LLMs or what's going on with generative AI themes right now, but even if we go back to say more classical AI tools like such as machine learning, it seems the most opportunities are either in the United States or in China. So, just curious about as you're thinking about AI, you're based in Asia, so that's your remit. What are the ways? I mean, LLMs themselves can be very tricky beasts, not necessarily, they're all losing money. Uh, so I don't know if that's and they require such vast amounts of capital. I don't know if that's really, available for a VC firm to even participate directly in. But what are the other ways that you're thinking about AI as it relates to the fintech space?
Yeah, that's a great question, and the way that you worded that there at the end really makes me think also about fintech as we've known it, and fintech often treated as a subset to SaaS, when in
Mhm.
fact theoretically the attributes of fintech, movement of money, regulated, licensed uh, intermediaries themselves in a compact startup wrapper, whether or not they're more akin to the old SaaS model or more akin to the the role that fintech companies had in SaaS, in monetizing SaaS versus monetizing AI, so to speak. It does make me wonder about how much does fintech change while the world changes. So from that viewpoint, I personally think that fintech has a huge role to play in the future of technology because it's relied upon to be that transfer of value, the movement of money, and ultimately a way to extract short-term economic value. What you said about whether or not venture capital can even embrace the capital intensity of the development of models, I think that's a very interesting question and an interesting way to look at it. We think about there's the model layer, there's beneath that the data layer, and above that there's the application layer, where agents, depending on how you want to think about and define an agent, fit in within the application layer or perhaps kind of right at the surface level of that. Is something that's still evolving, and depending on who you talk to, there's probably different opinions out there about it. The way that I the way that I think about investability in that space is, yeah, there's going to be it's like it, it's going to be going to different parts of the world and seeing where is the talent moving around, mobilizing around these ideas.
Mhm.
What is the capital that they need to mobilize around it? And what's the capability that they're going to need around that? Is it going to be something is it going to be open source based and it's going to be more of these large distributed communities where geography doesn't matter? Or is it going to be the more localized, hey, here's a small SWAT team of folks getting together and building a company. And then because they have to 10x what that company becomes later on because it's the AI format, then how quickly can they reinvent themselves locally versus how quickly can they reinvent themselves on a distributed basis. So
Yeah.
whether or not it's the same playbook for growth that existed previously in SaaS and fintech versus whether it's a new playbook in I think is a very interesting plot line there.
And because we're in such uncertainty with these things, I was going to sort of finish, Evan, by just a very standard question like, okay, so what are your top sort of sector picks within fintech? But I think what I'm going to do instead, I think what might make this a little more rewarding is ask you, what are the big problems today that banks, insurers are looking to deal with, where you see, where you can play a role helping them work better with fintechs? So what are the problems? And then from there, maybe we have some insight into the way you see where the opportunities investing in fintech will be.
Sure. Yeah, that sounds great. So the we'll start maybe at the largest macro level, and that's that there's a great difficulty in leveraging OpEx towards bringing about the change within the four walls of a financial institution. You can't just splash out a bunch of money and decide that you're going to build something. Even within the build buy partnership, it's probably going to be more of a combination of those three rather than an either or. So companies in fintech, specifically in insurance, that are leaning into that are certainly ones that are of interest. I would consider maybe a subset of that, or the next step down the road and going that direction and getting more specific would be getting the right product to the right client at the right time, so that the rise of separately managed accounts, the applicability of direct indexing to portfolios, the development of a truly multi-asset portfolio that includes both public markets and private markets assets, where private markets assets are facing a wide open space of this arguably pre-regulatory phase. I mean, it's regulated, but not in the same way that the public space is. And finding out where's the market structure going to develop in private markets. So we're largely talking here about PE, VC assets that are more than just fractionalized down through a traditional feeder fund structure, but getting down to the level of whether you're a high net worth individual, a ultra high net worth, family office, multifamily office, OCIO. The portfolios are larger now, driven by a generational transfer of wealth at a macro level around the world that we haven't seen before. All of those parties that I just rattled off, they're all about to become much larger than they were before. And it's not going to be the traditional 60-40. It's going to be a mix of public and private assets together in the portfolio. And so how does the existing infrastructure around the service providers, the tech properties, and the other market structure, and the coterie of advisors that exist around those folks mobilize to move with that shift towards a truly multi-asset portfolio is a big opportunity for investing, I think. And in the world of insurance and healthcare, it's the idea of how do you provide the greatest amount of care to the largest number of policyholders at the lowest cost. And if you can solve those problems tactically to where, you're not going to solve it with one fell swoop. It's a given that a solution to those problems is going to be a composite of multiple strands, and that those individual strands will together provide that kind of lift. That's where we see, okay, where is there a company that is going to make the investing in, let's say, a private markets and public markets program a lot more scalable across an entire financial institution's customer base and client base that is by definition extremely lumpy and varied? How can you do that in a way that's going to provide real leverage, in a way that just spending money on tech isn't going to make it happen? So that's another area that I think is pretty compelling.
Great. Well, Evan, we've gone beyond our normal 30 minutes here at DigFin. I've been enjoying this conversation, and of course, I could indulge in a longer one, but I don't want to take advantage of your time or our readers. So this leaves me just to say thank you so much for joining me on DigFin VOX.
It's been great to be here. Thanks so much. I really enjoyed the conversation, Jame. Let's speak again soon.